We're glad to have you back. Stocks at the Nigerian Exchange rose 0.56% on Thursday, May 27, breaking off a spell of loss-making that has held the markets for nearly 2 weeks in a climb that saw shares regain all the grounds lost at the previous session. For the ninth consecutive trading day, equities trading on the floor of the Nigerian Exchange Limited ended in the negative territory as the lead performance pointer, NGX All Share Index, gave up 49 basis points of its trading points and closed at 38,044.58 deals from 8,233.68 deals. Sector heavyweights including Seplat, Nestle and Dangote Cement led the comeback, hope to set up a healing process for a bruised investors' confidence that has kept market activities at low ebb for days. Market speculations heightened that traders already received every key economic indicators, such as inflation figure for the month of April, GDP details announced by the NBS, saw a marginal improvement at the Nigerian Exchange. Nevertheless, analysts argued that the inflation figure is a sharp deviation from the trend of food prices across the country, while the 0.51% GDP growth rate stood far below various expectations and projections, as traders will now play more by speculations and individual equity strength. He's joining me live via Skype. He's the head investment research at United Capital PLC, Mr. Wale Olusi, to talk about this and, of course, other issues relating to the markets. Good afternoon, Mr. Olusi. Thank you very much for your time.
Good afternoon, Tolu. It's a pleasure to be here.
It's the last work day for the month of May. Let's start off with your full assessment of the performance for the month of May. Can you please break it down for us, even on sectoral basis?
Right. So thank you once again for having me. And yeah, it's been a very active month. What we think has happened so far in the month of May is a situation whereby it looks like market participants, both investors and speculators, as well as traders, are basically taking profits. From the earnings season that we saw in April, a lot of Q1 numbers came in. So from late April to very, very early in the month of May, the market was actually up. But what we've seen in the last two weeks up until today was broadly a sell-off. The market so far in the month of May is down over 3.9%, although it's a bit up today. Market is closing it actually just closed about a minute ago. So, but give or take, we expect it to be down by over 3% in the month of May. Some of the biggest driver by sector include the likes of the telecom. MTN and Airtel, dropped significantly. Airtel dropped more than 10% in the month of May alone. Don't forget, Airtel was significantly rallied last year. Also, if you look at the industrials, Dangote, Boa Cement, these stocks also, dropped significantly in the month of May. But we saw some interesting interests, if I'm allowed to put it that way. There are buy interest in the likes of Seplat in the oil and gas sector. One, the Q1 number was very good because of the rebound in oil prices. And then Seplat also came to the market and told us that they want to be doing quarterly dividend. So Seplat has done very, very well. Some of the banks have also done very well, the likes of Zenith and Access, on the back of the rumor making the rounds that there's a likelihood for acquisition of UBN between the two of them. But the likes of GT, FBNH, as well as UBA has not done very well in the month of May for reasons that are in the market. FBN had a dramatic change of board during the month. For GT, I think some people are selling ahead of the restructuring, but we don't think that's necessary. And UBA, I think the disappointment from the full year quarterly interim dividend, full year dividend is still driving sentiment. So that's what has been happening across sector. It looks like there are opportunities, pockets of opportunity in select stocks, but overall market sentiment seems to have been largely bearish. I think it's mostly in line with what they used to say: sell in May, and then maybe you should come back later in the year.
Selling me and maybe come back later in the year. Let me follow up by asking you, do you think we would or could see a twist in sentiment as we're inching, yes, of course, by tomorrow is going to be the first day in the month of June, to the second half of the year? Decline in equities market was a concern for the MPC meeting during their last meeting, and all of the reverse we saw in the inflation and this marginal growth, will that say that we are back at the market for positive trade?
Well, I think from the policy and the macroeconomic point of view, there are no surprises again in our view. The MPC have met. The next meeting will not happen until the month of July, which is late in July. Inflation have clearly shown the direction it wants to take. 18%, moderation or not, 18% is still well above the yield in the environment. The yields have also, largely reversed. For treasury bills, central bank have begun to show signals that it may not be, pushing ahead so fast anymore. So it doesn't look like there's going to be any surprise again in the market. And by the end of June, going into July, we should start getting results for first half of the year. Some banks and some consumer goods always pay interim dividends. So we think these are the issues that will drive the market. We think the fact that the market was sold down significantly in the month of May may trigger some bargain hunting in June. But I think until the results start coming out later in July, we are unlikely to see any significant interest in equities. Overall, it looks like it's mostly neither here nor there for the rest of the quarter, because I think the only thing that can drive the performance now is probably earnings. What is happening in the yield environment is also something to watch, because there's also asset switch is not yet over. And then the concern about dollar valuation against the naira is also something. It looks like a lot of funds are also escaping the domestic market into safer havens. Look at inflation, for example. Look at the valuation. If you put all of those things together, people are not so very comfortable keeping their assets in naira. So if you look at all of those things, we don't expect the market to crash, but the sentiment is not so strong to push the market, significantly higher than where it is now.
And Mr. Wale, we saw local players very active in the market before now. Do you still see them maintaining that pace this time, despite all of the challenges that we see?
For us, we think the market is still a local play for now. Foreign investors are not coming in, at least not into equities. So it's still largely a local play. Most of the transactions you will be seeing will be driven by local retail investors, domestic institutionals, including proprietary traders, including PFAs and asset managers, who already have exposure since last year. Don't forget what happened in the fourth quarter of last year. There was a lot of interest from locals in the equities market, and many of them are still significantly invested in this market. So we think they are still the one either trying to exit or trying to rebalance their portfolio. They will still be the one to continue to drive activities. The only foreign participation that you will see is probably what we have been seeing, a situation whereby the ones that are already here are basically just increasing their stake, maybe buying back their own shares with the dividends they have or the capital they couldn't repatriate. But that percentage is significantly low compared to what it used to be. If you look at the ratio of FPIs to domestic investment from last year till date, based on the latest number, it's still around 70% or more compared to foreign portfolio investors that are doing about 25% or less. So I think it's still a local play largely.
Okay, I want to take us a little bit backwards to when the demutualization process. A lot of expectations after this very big event, and some saying Nigeria has done global best practice, talking about trading and also operational strategies and all of that. Now, Mr. Lucy, what are the positives? What do you see? What does this really hold? What does it have in stock for the Nigerian Exchange Group? All of these changes that we saw very shortly.
Well, I mean, I think it improves their performance, it improves their drive to become more profitable as a business rather than what they used to be. I would imagine that maybe the Nigerian Exchange Group will be pushed to think about how to deepen the market. We need more companies to list. We need more sectors in the economy to be represented in the stock market. So I would imagine that with the demutualization and what I would refer to as a situation whereby the exchange is more commercialized, will push them to want to do more, to want to deepen the market, to increase the amount of products, the robustness of the market. So if you look at it from that perspective, it's positive for the entire economy. On a micro basis, for the investor of the exchange, they can now trade the shares, although on NASD is not yet listed on the exchange, on the Nigerian Stock Exchange itself, but they can now trade the shares of the NGX, on NASD. So I mean, that improves liquidity. It also provide for price discovery. But for us, the areas where many investors will benefit from what they've done is a situation whereby that restructuring drives them to improve the number of listings in the market, the number of products, the depth of the Nigerian stock market, as well as capital market as a whole. I think that's where the real, because for now the market is still very shallow, and we need to do something about that.
Okay, something just pricked my mind. Earlier in the year too, there was this shift to the fixed income space where everyone started to move away from the equities market. Are we still having that same kind of move? Is that still happening across? And what's the interest? It's just about the market looks better than the equities market, or what's the reason? What's behind this?
Well, I mean, like I mentioned earlier, if you look at 1 year Treasury bills stop rate in January, it was less than 2%. Today, 1 year Treasury bill stop rate in the primary market is about 9.65%. So yes, there's still a lot of asset switch that is ongoing. In our businesses, we've seen some movement. We've seen investors liquidate some of their holdings in some asset class, to move it into some other asset classes. So that's still happening because of the attractive or the rebound in the yield environment. Our money market fund has also seen improvement in the returns. Prior to now, it was returning about 4%, 4.5%, but today, as of the last check, we are doing roughly 6.7 to 7%, which is very, very significant for short-term investors who may want to come in and go out at any time they want. So, for those who are not comfortable investing in the equities market because they are not sure, I think you will see some of them also selling off their holdings there and put it in some of these funds. Yes, the return is not so high, but it's more or less risk-free, almost guaranteed. So we continue to see that for those with the liquidity, they can go directly and buy 1 year bill at 9% or more, close to 10%, and lock it down for about a year. So I think that is still happening significantly. The only worry is that even at these rates, they are still significantly low compared to inflation rate of about 18%, which makes the real return on many of these investments negative. If you look at bond as well, if you go back 4 or 5 months from now, none of the running FGM bond is running at a discount or even par. Many of them are trading at premium. Today, most of the bonds are running at discount, suggesting that the yield has significantly improved. So those who have long-term view and are comfortable with bond, many of them will come now and lock their, fund in some of these bonds and simply hold to maturity, depending on how long they can wait for. So compared to what was happening last year, where average bond yield was doing about 6%, today average bond yield is doing twice that, about 13-12%. Even for FTDs, that's fixed income deposits in Nigerian banks or commercial bank, if you have up to ₦1 billion today, I think you may be able to get some FTDs at more than 10% today because of the liquidity needs from all of these banks. So asset switch is still ongoing.
All right, there is a good way to leave it there, Mr. Wale Olusi. Thank you very much for explaining this to us and making more sense of what has played out in the month of May. Head Investment Research, United Capital PLC. Thank you very much and enjoy the rest of your day.
Thank you for having me, Tolu. Have a nice day too.
All right there.